I'm not sure if it's confidence or just false bravado. I mean, all of these major indices are down 10% in corrective territory. So for you not to be stepping in and participating is probably somewhat of a fool's errand. Frankly, I think I see this from the other side of the coin. I think that we have started to see a bit of a correction. You've started, Mike Wilson had a great note out today, essentially talking about some of the breadth waning, seeing some of the up revisions waning. I think you are starting to see some of the undertones of a more conservative Fed start to kind of play through. I think you are starting to see some of the cracks for the consumer. With that said, it's not right for us to expect this to be a precipitous fall down and to the left. So you are going to see some pockets where you're going to find some stability. But it was just last week when we were saying, listen, these markets have been able to hold 4,200. Speaking about the S&P, that's a key technical indicator. That is now going to be probably offering some resistance from the top. So I would be careful before I would be willing to jump back in with both feet. But down 10% in a market where we are still seeing robust economic data, I do think you probably want to take this opportunity to at least put some chips on the table, but start to average it.
Yeah, Karen, I mean, in that Mike Wilson note, he says a strength in the headline labor data masks the headwinds faced by the average company and household that the Fed can't address proactively. What do you make of that?
Well, I'm not quite sure. I mean, so if the economy slows, is that good for the market? Right? Maybe, because that takes the Fed out of the equation and I think that there would be sort of a knee-jerk reaction. So if the economy slows, though, does that mean that companies won't earn what we think they will earn? Yes, maybe that as well. And who knows on any given day which of those weighs more. I kind of think the Fed being done weighs more. But I don't know. I think the other thing we saw, I don't know if we'll get to it later or not, was the refunding announcement, which was fine, which was fine. Last time it was not fine. It was huge, and that was scary. So fine is good. There was another leg up sort of when that came out. But I think I mean, it just seems so overdone. This is a really nice rally, but it only takes us back to Thursday at 11 a.m.
Yeah, that's true.
Right? So, you know, I try not to get too hopped up on it. But I also think things like, to me, that Meta reaction to that earnings was, I didn't understand it at all. I didn't understand why, you know, United Rentals, the reaction to that earnings release. Finally, at the end of the call, it started to trade up. But so I think it was just this overdone negative sentiment starting to lift a little.
Dan, is any part of that the fact that we're here in October and that this month is always a bit of a scary month ending, but seasonality play a part here?
Listen, this is very similar to late 2021, okay? When the rates were still really low, the Fed said to battle inflation, they're going to start raising interest rates. And we just had some of the highest valuation stuff, the stuff that didn't make money, the most speculative stuff in the market started selling off. And, you know, we were still making highs in the S&P 500 in the first week of January 2022. And so I guess what my point here is, like, what's gone on for the better part of the last 3 to 6 months is that most of the stock market has been trading very, very poorly, you know, and we've had a handful of names that have been doing all the heavy lifting, and the market, you know, cap weighted indices, and under the surface, it's been really bad. The equal weight has not been great. You know, the small caps have not been great. I'm looking at utilities, real estate, consumer staples, healthcare, financial services, basic materials, energy, industrials. They're all down on the year. OK, so if you're still clinging to this 8.5% rally that the S&P is up, well, it's in about 10 names. OK, and if you think the 10 names are the stock market, then they're not telling you what's going on, at least the way I see the equity markets, what they are saying about what's going on in the economy right now. And so to me, I think that, you know, a lot of the data that we're seeing as it relates to jobs, and we're going to get that October jobs report on Friday, we have a 3.8% unemployment level. That is very near 40-year lows. OK, so that's masking some of the other stuff that's gone on in the economy. So if I'm just thinking about what Karen just said, well, I'm not sure how Meta or some of these stocks are related or, you know, reacted towards their earnings and the guidance. Most stocks are not acting particularly well relative to their earnings and their guidance right now, no matter what it is. I just think that expectations over the last 9 months have gotten way too high relative to where the economy is, relative to where rates are. So to me, I just think that a lot of what's gone on over the last few months makes a lot of sense. I think there's a good chance that S&P gives all of these gains back up on the year. I think it'd be very hard for the NASDAQ to. We need to have some of these big names in this Magnificent Seven, or whatever they're calling them, would really have to be some disasters out there. And, you know, I don't think those are lurking right now. I think it will take some degradation to the economy to have some of those big names to really have disasters. But make no mistake about it, there are some that are falling by the wayside, and Tesla's one of them. I know we're going to talk about that later.